I'm a professional funded day trader with my Forex funds, and I'm going to share with you the exact strategy step by step that I use to get funded. While market structure, points of interest, and liquidity are all very important parts of our trading plan, there are a few videos who go step by step and really show you guys how to put it all together. So let's go ahead and get into it. Let's say you're something like this, and we'll assume that the structure's been bullish. Well, first off, structure is king with everything. It's going to be your foundation for bias. It's going to be your foundation for entry. So if we have bullish structure, the next thing we want to identify is discount and premium. So if we are in a bullish price swing, and we are close to or we've traveled into a discount and seen internal structure showing the desire to go higher, it's pretty likely that we are moving back up to this high. Now, that probability raises whenever we have traded into points of interest. Now, this could be a fair value gap, an order block, whatever it is that you use for your marking out your areas where there is a high probability of reversal, your points of interest. Your draw on liquidity is going to be up. Now, your overall draw is going to be that high. If you're in a bullish market and price is traveled a discount, we've seen nice sweeps on liquidity, followed by displacement coming out of those zones inside a point of interest. You just look for upside. You come into the market looking to buy. Now, is every single day going to be a buy day? No. And as you get more involved in day trading, and you're specifically focusing on a select couple pairs, you're going to understand you don't have to even get a trade every single day. Day trading doesn't mean trade every day. It just means that you hold a trade for less than a session. That's all it means. You don't have to trade every day. And too often do I see people, once they learn the time and price theory, they think that every time that kill zone, or every time they tap into under the open or whatever, that they have to trade. You know what I mean? And if it doesn't support your bias, then you're going out of your trade plan, and you're automatically cutting your profitability and your probability of success down tremendously. Because sometimes we might have an order block after we've traveled up in this area, and price may have been moving up every day, and then it moves down just a tad, right? And that might be a down close day. Maybe you got stopped out on that day. Maybe you didn't trade. Sorry, guys, excuse me. I don't know what's wrong with me. But either way, you don't. First of all, it's not going to kill you. Let's just say if you're bullish all the way from down here, and there's been 15 days of just regular price action, and 12 of those days were bullish, and 3 of them weren't. And out of those 12 days, you won even half of them, right? As long as your risk reward is good enough, you're still going to be profitable. You don't have to win every day or trade every day. Now, whenever you're talking about your bias, you can get a little bit more in depth. Like, let's say if on this day you would hit an order block, then you look on your 4 hour or your 1 hour, and on the 4 hour or the 1 hour, that gave you some kind of price action like this. You had came up in that area, and you'd seen a shift down, and then when you came up to the market, at market open, you were in the premium maybe of this swing, after you'd seen a shift down in an area where you are likely to see some resistance, but you're not likely to just take out and go down to the low, because we're in a bullish overall swing. So in that day, you may have been able to develop a bearish bias, and you're going to get better with that with time and experience. I strongly think that daily bias is the most difficult part of day trading, but it is also the most important, because it's what trains your eye for what you're looking for. So maybe on a day like this, yes, the overall draw on liquidity on the daily is up higher, but in this example, you tapped into an order block in a premium, and you saw the 4 hour, the 1 hour shift down, and you come into the market, and let's just do another view. So like right here, it was the 9:30 equity open for indices, we'll just say, and right here, price had made some, let me use a path, had made some highs, and you're watching for setup, and it's maybe coming into 10 a.m. and it gets a nice shift up and then a push down. Well, you can say that we're likely drawing down. Now, whenever you're developing a draw on liquidity like this, it's easier to just, in my opinion, just pick the low you made, like that most recent low, or over here, I guess, because we're talking about if we're up in this area, the most recent internal low in the daily, or any order block or fair value gap on the 4 hour time frame. You don't have to swing for the fences, nor do you have to have very distant targets to make money. 2 risk to reward, 3 risk to rewards is ample. So on a day like that, you could use all of your, you're using your daily, but you're using your daily bias. Okay, yes, we are targeting, this is our overall draw on liquidity. We are in a order block. The 1 hour is telling us, they were shifting down towards something, but you're aware that that's not likely to go much lower than the most recent area of daily bullish order flow. So yes, you're counter to the daily, but that happens, but you just don't want to try to target, the fences. You want to just look for where's the next daily order block? Where's the next area of liquidity? Where's the next, you know what I mean? So it's a little different than if you want to, now if let's say if this price comes down here after that day and you're now in a daily order block, well, now you're going to be bullish again because the daily is telling you to be bullish. But that's just a little bit of a look on, how I try to do daily bias. I could spend too much time on it. I probably already have spent too much time because that's not what today's video is on. There's another video in this playlist if you want to watch on daily bias. But so after you've established your bias, if you're thinking we're going to go up today or we're going to go down, right? It's that simple. It's a little harder to determine that sometimes. I want you to think like a market maker. So you have some price action like this, and price is going down in the lower time frames. But you know that you're looking for a long. So you get that the markets maybe have been open for a little bit. And this looks decently bearish if you're just looking at this structure. But if you look at it in the form of, in the context of your bias, what is the opposition thinking? So if you're bullish, not based on this, because we're basing on the high time frames, because this right here, I could see why you'd be bearish, right? Because we're making lower lows, lower highs, lower lows, lower lows, lower highs. So maybe you see an order block right here, and you see, oh, we rated this liquidity, and we're coming down, and we're now we're going to come back up to this order block and just continue this bearish order flow. Everybody knows all trends come to an end, so to speak. So we know that if we're bullish on the day, we're expecting this to come to an end. So you have to think, maybe this is what the opposition is trying to target, right? So guess what's going to be beyond that? Stop losses. And it's also, once you get confident in this, it's going to help you understand, just because price comes, like let's say if you're bullish in the day, just because price comes up here and it gives a pattern, right? You're going to say, oh shit, we're going to go down, It doesn't necessarily mean that day is going to be bearish. You can maybe take this low and then start to shift and really start pushing, and you just have to be confident and not switch up, because it's easy to maybe see another lower low when you wanted the structure shift, and now you're saying, oh fuck it, I'm gonna short, I'm changing my bias, and then that's what you're hoping for, but then this happens and we hit an imbalance that you didn't notice, and then bam, boom, goes up, and now you just missed the move because you shifted your bias. So I want you to always think like a market maker. Just because price is pushing up, maybe it's a market maker pushing it up to induce a false narrative. And I want you to identify like smooth areas. So like for instance, in this model, this is actually kind of like a market maker model. I guess my brain's just drawing them at this point. Here you would expect a smart money reversal, push up, and then more consolidations, and then you're immediately going to push up to these highs. Because if we're thinking like a market maker, if we're looking to long, right? Well, where are we going to be able to sell? Where are we able to sell? At areas of liquidity, right? So equal highs. You just got to think what the opposition is doing. Like, where are they looking to get in, right? So they might be looking to get in here, so that's going to be a draw. Or where they're looking to, maybe get out, so to speak. If they're in a short, you look at the screen and say, okay, if I was in a short, where would my stop loss be? So you're going to look at that, and that's what you're going to target, right? Now, it can be a point where you take everything off if there's good enough risk to reward, or maybe where you take partials. The idea here in this first segment, I just want you to try to build like your plan for how you figure out what's going on, so to speak. So after you do that, you're going to have identified your low-hanging fruit. So in that example, the 3 equal highs that I had drawn right here, that would be your low-hanging fruit, because maybe on the daily chart, you're bullish on the daily chart, and we'll say, this is what you looked at in the morning, and then the lower time frames had that consolidation forming those 3 equal highs. Forgive me, my drawing skills are not maybe the most pretty, but I'll get the point across. So let's say you get that run on stops right here, and you're forming the bottom wick of that daily candle, and you have these equal highs right here. Maybe that's right there, right? It's gonna. I know this is a daily. I'm trying to draw a daily, so it look much more condensed. It probably should be one high on the daily, but your overall drawn liquidity maybe is up here, because you're expecting us to go out and take the buy side because we're in this bullish range. So you've came down, you've tapped here, you've shifted. This shows you're reaching for this. So this is your overall draw on liquidity, and this would be your low-hanging fruit. So when I say swing for the fences, just because you get a run here and you may be caught the low of the day, you need to be taking something off here, or maybe take it off in full if you're newer, or especially if you're trying to go fund to challenges. This is where you just boom, get that money, right? Sometimes this will happen in 20 minutes. Sometimes it happens. It takes all day. Sometimes you're gonna be wrong. It's not gonna happen. But you want to identify that low hanging fruit. This oftentimes is going to be your 15-minute swing points, your 15-minute equal highs or lows, and your 15-minute areas of interest like an order block or a fair value gap. You want to look at those low time frames and identify some low hanging fruit, because once we establish draw and liquidity, which is based off of the expectational order flow, or we have a bullish market, you're targeting the high. But are we going to really hold our trade that we've got intraday all the way to that high right there? Maybe you develop a plan where you can do that, but when you're newer, you want to shave off something here. Now, maybe you shave off 50% and put stops at break even and then hold till there. That's fine, but just get in the habit of identifying low-hanging fruit and taking some money out. You got to pay yourself, especially when you're learning, because it's really easy to learn something and you get excited, and once you get good at drawing liquidity, you're going to start trying to push it and be greedy and not take profits when you should, and it's going to hurt you in the long run. So I want you to get really good at identifying low-hanging fruit. And again, this is for day trading, so I'm not trying to undermine anybody's swing trading strategy, and don't get lost in the sauce, so to speak. And remember, what we're talking about is just intraday trading. Specifically, I trade indices mostly, so I would be, more so focusing on that. Forex as well, but crypto is more for swing trading and stuff, so it's gonna be a little different. I want you to also identify that final target, which is the high we just talked about. So you need to identify that. So you need to be aware of that, because that is telling you the magnet price is pulling towards. But you want to look at kind of res stops, so to speak, along the way. If you're on a road trip, you're going to I don't know, wherever, 12-hour drive, you're going to stop for gas. That's what you do. That's your low-hanging fruit. You got to stop, get some money, move your stops up, and get used to doing this. And it's okay to not hold, every last bit till, 20R or 10R, but you can always leave a run or two to help psychologically, because a lot of people think they missed out, and then next time they're like, oh, I'm not taking any profits, and that next trade reverses. You guys know how that goes. So it's really important that the low-hanging fruit, I cannot stress enough, paying yourself. Because let's just say if you have 3 to 4R a day, on your main target, but that low-hanging fruit's 1 or 2R. Let's say if you get in the habit of taking 50% here, 50% here, 50% here. You're taking 1R, break even your stops. You're slowly building your account. It doesn't have to be home run trades every trade. When I passed my funded, it was off of lots of low-hanging fruit. It was off of 2R trades. I was not, there was one trade I took that wasn't, which is a Bitcoin trade. But other than that, it was off of mostly gold and S&P and the NASDAQ, low-hanging fruit, targeting the most recent lower time frame draw on liquidity and just getting out, But after you've identified both the low-hanging fruit and the final target, that's where you know what you're going for. So now you need to look at the chart and say okay, I know where I think price is going as far as direction, and I know what levels I think price is going to, and this is why I think that. And you're thinking like a market maker, and these are areas where it would be likely that my opposition is going to get stopped out or maybe enter the market. So you've thought, okay, where am I trying to take price? How am I going to pair my orders, so to speak? And then you've identified little targets of actual price levels, not just directional buys. So now I want you to map out key time levels. So the more and more I trade, the more important that I realize time is. And if you're day trading, you need to be very aware of all these levels. And it might sound I remember when I first learned this, it sounded almost too complex or too much, and can give paralysis by analysis. I understand, but I think it's really important if you want to be precise, and also it's going to limit you from taking too many trades. So I want you to, from indices, I put the midnight 8:30 opening prices, the London high and low. Now I've done a lot of back testing recently. I have used the Tokyo. We talked about using Tokyo for Asian range or the Tokyo high and low, and then we've talked about using Asian range and the central bank dealing range. I think it's much better for Forex. It does work sometimes for indices, but again, like I said a second ago, you can easily get paralysis by analysis. So I want to simplify it for you guys. So if you're trading indices, just watch the London high and low, because let's say if you had these equal highs we were talking about and the price moved down, and then you're here at 9:30 down here, and you notice these, and then you say, oh wait, that's the London high. There you go. Now it's okay, I've got time and price on my side now, and I'm using time because I'm trading within this time window. So now you're getting to the point where you're much more precise, and the whole idea of a lot of ICT stuff is based on time, and that's what a lot of people fail to. And a lot of the people that make newer courses, I see that people don't include that, which is it's extremely important, extremely important. So map out all your key time levels. So if you trade Forex, here's the ones you focus on. The only thing that's different is you map the Tokyo high and low, and then watch standard deviation, which we've talked about advanced targeting methods in another video titled Advanced Targeting Method, using the central bank dealing range and the Asian range. I'm not going to get into that. Now, the most commonly misunderstood thing here is that you have to have a run on like the London high or London low or something like that, to have a proper daily bias. Now, I have talked about using that, the Asian range, you can use in terms of your daily bias. If we have an Asian range and you see London manipulate it and then we come back down, you can look at that as a bearish day. I'm not saying never to look at the Asian range, but I am saying don't try to use the standard deviation fibs for indices. They're just not consistent enough. And you don't have to have this for a bearish day on indices. It's an ideal setup, but you don't have to have it. So again, structure is king. Don't overthink it. Really just use structure and displacement for daily bias. That's my biggest advice. Is like, okay, are we in a bullish external range? Yes. Okay, are we in discount? Yes. You're most likely looking for buys, but you want to see structure. Okay, have we seen structure to the upside? Are we in a point of interest? Yes, now you're bullish. It doesn't go much farther than that. So don't overcomplicate it and don't make it any harder than it already is. Last but not least, as far as, when you want to trade, you want to just wait for your kill zone. So, if you are trading indices, I would recommend waiting for really like 8:30 to 11, but even waiting for 9:30, I think for beginners especially is important, because you always get a run on stops after 9:30, so it's easy to get wound up in that. Now, once you get a little bit more experienced, you'll be able to kind of participate in that run on stops, but I want you to focus on waiting for your ideal time, and then looking for your entries. So that's pretty much it for the plan. So it's like, this is like you're building your narrative. So after that, I want you to kind of, how am I going to pinpoint institutional involvement? Because again, we have these areas where we want price to go. We have our directional bias, and we have an area, we have time-based levels that we're looking for price to either travel beyond or travel to in order to get active in the market. Ask yourself the first thing. This is like the most important thing. And it's the biggest way I can simplify it, is ask yourself, have the stops been taken? The whole idea of this type of trading is manipulation. So if there's no manipulation, the odds of your success are lower. If you're like, for instance, if you're looking for a move to the upside and you haven't seen any manipulation of the downside, well, then price has no fuel, so to speak, to move up. Right? You got to think of it. Those of you guys who have been in Playbit for a long time will remember this, and you can go watch this video. It's the, I think, intro to liquidity concept. So it's one of the first class format videos that's in this playlist. Like, price needs fuel, right? So if we're just moving and price is kind of running out of gas, right? But it needs to get here. Well, it's going to have to go down and get all this I can't even talk, fuel from these stops right here. There's a liquidity pool down here where there's fuel. So, all that cash that people are losing, and those positions that people are getting manipulated out of, smart money is going to take and absorb that. And that's how it's like, okay, now we've got enough fuel. Now we're going to draw on liquidity. Have the stops been taken? That's the first thing and the best way to simplify. You identify draw on liquidity. Ask yourself, have the stops been taken? Then look for an entry if they have. And if they haven't, you wait. It's that simple. After you ask yourself that, let's say if there's been no stops taken in your session, just wait. And sometimes price is going to go without you. That's going to happen 100%. I think it's much more efficient to just wait for stops to be taken. Once we get stops taken, then we get a reversal. You're likely putting your stop loss with, institutional investors. If you're not, you're kind of just trying to get in along the way. It's not impossible. I do it, but it's definitely difficult and it's lower probability. It's something you just have to get an eye for and get used to. But if stops have been taken, ask yourself, has price ran through key time levels? So you have, price moving, and price has ran down here and it's ran back up, and you see this and you want to say, okay, like how likely is this that this is going to be the reversal? Let's say the 8:30 open was something like this. All right, so you're trading indices. We'll say the 8:30 open was right there, and you have this is the 9:30 price point opening, and after this you're waiting for that run of stops. You get it right there. All right, so you've taken out that liquidity. So this has been taken. You've taken out all this. You're after your kill zone, so to speak, your time where you're trading, and then you've traded through a key price or a key time level, which is the 830 open for indices. Now, on top of that, let's add on some, this alone right here. If you see a lower time frame entry model here, you can take that, because think of time. I want you to really get in tune with time levels, because we have fair value gaps and we have order blocks, and we have everything else, and that does work alone. But time, think of time as a point of interest too. Think of your 830 open and your midnight open. This is everything we're stacking on kind of stacks on your probability, right? So let's say we see a push under a time level and then a displace or break a structure. Now this is the required part. You have to have some kind of displace or break a structure. So after we have that, we came under the 830 open and we got a displace or break a structure. That's, you've got some probability that that is going to be the start of a big move, and we might start moving towards that draw on liquidity. But how can you amplify that probability even higher? Well, let's say if you had that 830 open and it also had moved into a fair value gap or an order block or whatever it is that you're using to trade. So that automatically has now, heightened your probability, because now you have two confluences along, this is the foundation. You have to have that smarter structure shift. For what I'm teaching you today, I mean, I'm not saying that you can't ever trade without it, but you can. But just focus on this right now. For this model, that's the foundation. Then you have your added confluences. You came under a time level, you've came into a point of interest. But you can do this, like let's say if you hadn't came under the time level, like let's say if the 830 open was all the way over here, but you see this, well, that's still doable, But again, it's just how many confluences do you have to your trade? If you have two, it's better than one, right? Or if you have three, it's better than two. So another thing that you can even you can add on to make this a little bit more in depth and higher probability is ask yourself, when was this point of interest created? This was created during the London kill zone. Maybe this was created during the last New York session when price started to move to the upside, right? Like for instance, sometimes I'll see stuff happen where it's like you have this big move, and this is like where we pumped up from the day before. Then you see this kind of price action, and then we come into that zone under the 830 open, and that's like your bread and butter, because it's like, okay, well, like we moved from this a lot, very rapidly yesterday. Like maybe it's a fair value gap created in this leg, or maybe it's the order block, or maybe you've swept out the equal lows. But you're just asking yourself, was this point of interest created during a key time window? Now that doesn't have to be the move of the day yesterday. It can be during the London kill zone. It can be during, right near the previous day's low or high. Just any key time levels. So determining your entry and stop loss, what everybody was waiting for. Everybody loves entries. So first thing that I want to make a very big point on is that for every good move, there are multiple ways to catch it. Well, first of all, for every large move in the marketplace, I promise you, not only smart money concepts traders or ICT traders are the only ones who benefited. Contrary to some belief that people don't make money out of smart money concepts, that's just not true. Now, within smart money concepts, there are still multiple ways to catch it, because I want to go over two types of entries. The first one, a lot of you guys are going to be familiar with, and it's going to be our lower time frame stop run entry. The components of this, pretty straightforward. It's your, these. Actually, I'm just going to do this so you can have more room. So it's going to be your run into your higher time frame point of interest, because we've already gone over all the different framework that you have for finding this point of interest. You run on stops into that area, and the point of interest can just be an area of liquidity, right? It can just be that liquidity run, but whatever your zone is that you're looking to sell or buy from, you get a run into that, and then you get another run on stops. So we've been talking about this a lot recently. So like for instance, let's say whatever area we wanted to buy is right here. Price comes into it. All right, we've ran stops over here at some point. Let's just say we ran a short-term low, came into it, you get a consolidation, maybe you move back up into this fair value gap, and you don't get much displacement here, and then you get another push down. That is your low time frame run on stops. So at this point, you want to see a big push up. So that's your displacement break of structure. So those are the three components. You run on the POI, run on stops, displacement out of it. Big plus with this is that once you get that stop run, like that second stop run, there's really no reason price has to return. If your bias is correct, to this level, there's no reason that price will go back to that until your draw on liquidity is met. Now, maybe that's your intraday draw, or maybe that's your overall target. Most of the time, I'm referring to your intraday draw. It's not like you get that 1 minute stop rate, and there's no reason price is going to go back until the daily draw and liquidity is met. If that was the case, we would just hold till then, which we've made it pretty clear that we don't do that. Mainly, take that as your intraday draw. Just want to clarify that because I wrote just draw. But if the stops have already been ran, then you're not risking. You're putting your stop loss in a good place because they've already been ran. So why would they get run again? It does happen. I'm not saying it doesn't, but that is one of the big benefits to this model, because you get that push and then you get the early trader stopped out, smart money enters the market. Now, one thing I want to be clear on, because I've gotten asked this quite a bit over a long period of time now, is just well, how long? Because this is where people get FOMO. So like this could take 20 minutes. It could take 2 minutes. Depending on if you're using the 1 minute, it can happen very quickly or take a while. Now, there's no time limit on that duration. It could hang out here for an hour and a half, right, in that point of interest, and then you get a big push down, then a push out. That's fine. There's no time limit on the duration of this occurrence. Just because I draw like a very quick model, that's just for explanation. It can take forever, right? Now, again, the reason we wait for that displacement break of structure and we require displacement is that if the stops are being bought up, then displacement will ensue. So again, we want to see this high taken out with force, preferably a candle close above it. So now here is where I'm going to simplify your entry, because like I said before, there's multiple different ways to attack. And we've talked about it, and I feel like I kind of confuse people sometimes when I say, hey, there's an order block here, there's a breaker block here, and there's a fair value gap that covers both of them. Now, which one's right? The answer is none of them are necessarily right? It's just what you use. Maybe you went back and tested on NASDAQ, it works best with breakers on this, and there's many different ways to skin a cat. Again, it's a weird, I almost hate that saying, but it is a saying. Anyways, the idea here that I want to instill is that you can enter anywhere in this range. Now you can go back and pick different ways to do this if you'd like, but really the most simple way to do it, if you want to set limits, is just enter as soon as we get back in that range, because this down move sponsored that up move. The whole idea, this could all be considered an order block, and it probably is on a different time frame. So that can be your entry with stops into this, or maybe you wait for a closure above this and you just enter there. I do both, just really focus on risk reward. For instance, if it's a massive move out, I'm probably not going to just market it there. If it's something like this, and I'm like, okay, am I really going to wait for, the half a point? I'm not. And a lot of people had said it's FOMO. I just have made more money. You need to take off. If you have a high value setup, don't be so robotic that you're going to wait for a pip or a point in the stock market to enter. It just doesn't make sense to me. So, again, you can enter anywhere in this last range with the stops above the highest high or low, and stops down under here. So again, you could put limits like this, or you could just enter like that. Now your target, we've already went over, is your intraday draw and liquidity, or areas along the way that, or use a fixed risk reward. Fixed risk reward is really good for day trading too. I think 2 to 3 risk reward fix is good, or you can just target the 15-minute draw. So now for the second style entry, now this is if you don't get a stop run, a no lower time frame stop run entry. Basically the components is we're going to get a run into the point of interest. So we'll have same kind of setup, but the framework's the same, right? So we have this run into the point of interest, and then you might not make it all the way back out. When we're talking about market structure, we have people determine strong highs and strong lows, or maybe some people determine structure that it has to take a low. Now, I've taught this method of structure, and I've also talked about institutional structure, which is just more displacement. So this is what we call a short-term high. Now, yes, it did not take a low, but it's still a high. It's not a strong high or a swing high or whatever terminology, but it's still, it's a pivot point. Whenever we see that running the point of high time frame point of interest, which is here, the rejection, now this is not where you enter, but you get a sharp push out, is when we retrace to the point of interest. So this is important. So again, we push down into this, we come up, and then we tap the fair value gap or tap the order block again. And this is why it's important to draw your higher time frame zones and just watch them and watch those levels. But we tap off that and then get a big push up from this, and you leave a fair value gap or whatever you want to do. No stop run here occurs oftentimes whenever there's a big run on liquidity beforehand. So for instance, some of you guys saw the trade I posted. Let me find it really quick. So notice how we had this massive push down with the CPI. Now we traded into a 15-minute order block, and then you see right here we have this high. So we pushed up and expanded rapidly through that high right there. Now notice we came down, we came up, I sat there and then just pushed. Notice this isn't as pretty as what I just drew, but this is the same thing. We pushed down, we created a short-term high because this candle right here is lower, so is this, has a lower high, and then we blast through a displacement. That tells me that enough liquidity was taken here on this sharp move, and it often happens with news, not always, but it happens with big pushes. Like when you get a massive push down, you push back up. This is still telling me that price is likely to move to this high. Now, that, of course, this was following bias. You don't just use this if you don't have other reason to believe this is going to happen. That I cannot stress enough, because if you just try to use these models just by themselves, you're going to get clapped. I want to reinforce that this is what you want, right? This is a higher probability setup, but it's not always going to happen. And as you get a little bit more nimble and used to things, you'll be able to identify this. But the biggest way I can make it mechanical is that you retrace to that higher time frame level, push off, and then when you break this structure, that's the same kind of trigger point that this has. So the way that I enter on these, I just enter on a displacement, break a structure. If I can, right here, like if I have good enough risk reward, I just enter right there. Sometimes it just depends, now let's say if it's moved like crazy, I'm not saying you have to enter every time this happens, but say if something like this happens, yeah, you're not going to move. You're not going to get in. Now stop placement on these is a little different, and it's going to be under that recent level. Because again, if you think like a market maker, if this is where you entered, you don't want to go, why would you stop yourself out? Think like that. That's why you use stops under this. So if you guys saw me, I saw, I don't know if LZH or LH, or not LH, it's LZH, I think, had asked me on, let me find some of this, because they asked me this question. That's kind of inspired me to make this video, is because I was like, I know exactly why they're confused. This thing was right here. Oh yeah, they asked me why I put stop loss above the high that I did, which was this, and because this was a failure swing. We came up, right? You see that displacement, and then you could have entered really right here, right? But I switched to this chart after this had already happened, and I noticed the move is going, so I just marketed, when I could. But I used this most recent high because again, this is, people are trapped. You don't have to. You're not trying to stop the market maker out, which is the high point. Another time this occurs often is SMT divergence. I meant to say that earlier. So look for this whenever you have ran a lot of liquidity, whenever you're using SMT divergence as a part of your entry, or if your point of interest was an area of liquidity. So it's easy to kind of try to force your eye to see this, and you enter too soon, and then you end up, price ends up actually giving that low resistance liquidity. Because look right here, you could have maybe said, if you're just looking at this, that this was a failure swing. Oh, there's a displacement, I'm entering. But you just got to be mindful of the context you're operating within. And again, what can help you a lot is watch for that test of the level and then the displacement. Because again, you don't want it coming back down here if you're a market maker. If this is where your stop loss is, you don't want price getting anywhere near that.
Thanks for making it to the end of the video. If you want access to the private Discord, use code CASPER, all caps, to start your free trial. That's where I provide my trade signals, teach my private classes, and you have access to one of the best trading communities out there. I really appreciate you guys taking the time to watch my content, and if you ever have any questions, feel free to hit me up on any of my social medias. They are all down in the description with the link to Playbit. Have a great day, and remember, if you can't see the liquidity, then you are the liquidity.